Happy New Year, my dear friends of Real Estate Investment Trusts. This is GCP Global, 35 years of public education, and we have spent 21 years teaching. So in this video, we're going to deliver a free gift for you. That is how to actually spot a toxic REIT before it becomes toxic. Now, this video is also goes to the heart of GCP's global teaching that really to make millions in real estate investment trusts. That's what I have written in my book, Making Your Millions in Real Estate Investment Trust. There are only really two things that you need to know. One is to make sure that you know how to spot the good REITs and buy them big before they actually enter. And in chapter 9 of my video, or rather my book, I have actually detailed chronologically, knowledgeably, as well as actually all the stakeholdings I have in Fraser Centerpoint Trust when I became its major shareholder and when I sold it, at above $3 in different timing. Now, the other aspect about making millions in real estate investment trusts is this. That is, you must be able to avoid the dud REITs, that is, the toxic REITs. Now, ladies and gentlemen, this is a video that goes to the heart of what we teach. So it is not a video or a criticism of the REIT. In this case, we are going to profile elite commercial trusts because we're using it as an example to share with you as what we have shared with our GCP Global investors in the last 21 years of teaching. How will we able to spot and avoid elite commercial REIT? It is not a criticism of the sponsor or the manager. So let's get down to it, ladies and gentlemen. Now, elite commercial REIT exemplifies, one of the so-called foreign REITs or REITs with overseas assets, which have severely underperformed, as you can see in the last 2 years. So the likes of Manulife, Prime REIT, Capital Oat, Pacific, Lippo Malls were some of the REITs that we highlighted previously in our previous videos. If you look back in the last 2 years of our videos production, as well as actually in our classes, in our public media interviews, that's where we have highlighted. And now Elite actually falls into one. So for example, take a look at the first chart. When Elite actually went for IPO in 2020, this is what they presented. So they say that they are actually leasing all the assets to one particular tenant, that is actually DWP, whom they describe as stable key occupier. Now, the meaning of stable, ladies and gentlemen, if you look at the next slide, according to Oxford Dictionary, is something that's fixed, something that's steady, not likely to move, to change, or fail. So one would presume, ladies and gentlemen, that if DWP had continued to remain since IPO for Elite as a major tenant up to now, then the fortunes, the DPU of Elite shouldn't change too much. Yes or no? Well, you be the judge. I will give you only the findings. I don't make any conclusions. I give you all the facts. So back to this slide again, you notice that essentially when they came for IPO, some of the things that we share with GCP Global students in our 2020 classes was that. Now, if you have not been to the UK, you please understand that values and of real estate, be it industrial, commercial, residential, villas, in London itself. It's very different from the likes of the same property in, say, Blackpool, even Liverpool, who is my favorite soccer team. More so if you move further up north towards Glasgow and Dundee and Edinburgh, which is actually Scotland, or you move west towards Norwich, Cardiff area, and even Plymouth area, or you move east, that's towards basically Manchester and Nottingham, right? So now this means, ladies and gentlemen, a few things. If you look at Elite, what they have been through since IPO is that they IPO at 66 cents, right? As you can see, the first rectangle enumerated in green. Now, since then, we have always tell GCP Global investor students to be wary of this REIT because one is that it lacks liquidity in terms of the trading volume. Two, the fact that you invest in REITs is that you are buying into something diversified. But in this case, you have a lot of properties, but they are only leased to one particular tenant, whom Elite has described as stable, right? So according to them, they says that they are the Department of Works and Permit or Pension is integral supporting UK social fabric, and that's why they're established in all different aspects of the UK. But indeed, does it mean that the valuations of the properties that are then leased to this particular tenant are they as stable as what Elite has actually mentioned in its prospectus? Because if that was the case, then why did the share price plunge from as high as 66, 68 cents, 70 cents in May of 2021 down to the low that we saw recently, 22 and a half cents thereabouts. So if you look further, ladies and gentlemen, and if you attended our classes, the first warning signal came almost a year after they went for listing. And that was where we shared with our GCP Global students in our GCP Global quarterly REITs classes. Yes, ladies and gentlemen, you can sign up for our GCP Global investment classes every quarter, which we hold and have been holding for the last 21 years. The next class is on 23rd of March this particular year. So back to Elite, we highlighted that, hey, for the fact that they told investors, in this case Elite, that it's rented to a stable tenant. Why is it that the value in terms of its investment property is down 15 million as of the first 6 months of 2021? Yes, ladies and gentlemen, problems already start to surface less than 1 year after they went for listing. You see, so in this case, you can see that that actually dragged down the reported profits from something like 19 million in the first 6 months of 2020 compared to only not even a million in the first half of 2021. Now, this was the first warning signal you should be taking heed. Now, looking back at the share price then, when we first highlighted, you notice that the share price, right, actually was still holding nicely. In fact, it went up, to the 70 cents level. And that's where we told everybody that essentially, if you were holding on to the stocks, you have to be very cautious. In fact, it's a good opportunity to be taking profits then and there. Now, the whole idea, ladies and gentlemen, is that if you look further, okay, the explanation from the manager in terms of the carrying value of the property is actually enumerated there. It is stated very clearly that the carrying values of investment properties at the end of the year were based on independent professional valuations undertaken by Colliers, as well as and recognizing the potential of the market, the conditions to move in response to changes in the control and the future spread of COVID-19 afflicting the UK then and there, right? So they also say that an increase in the yield rate will result in a decrease in the fair value of the investment property. So in that regard, as you know, this is essentially how the changes in cap rates can possibly wreak havoc on a REITs portfolio, something that we warn in our investment classes. Now, once again, now this next slide actually shows you my latest interview, in this case, in the Business Times podcast with the handsome gentleman in green, that's Mr. Leslie Yee, who actually writes very critical and in-depth articles for Business Times, and you should be following them and reading them every other week. Now, in this table, we told you previously, stay away from toxic REITs. And you can see that Elite actually falls into that category. In this downturn at its worst point on the low of Thursday, 26th of April, the low of Elite was 22 and a half cents. So right now, they came to the market and come next week, they will be asking you to cough out money to actually subscribe for the rights issue. Then you have to ask yourself, are you actually throwing good money after that? Well, so if you are still a shareholder of Elite Commercial Trust, you really have to think hard in this regard. Now, because the second problem that came through, was the latest results. In this case, you can see that the top line revenue was up 3%. The net property income was up 10%. Well, that's because of the acquisitions that they made. But You can see, ladies and gentlemen, when it comes to the very important amount for shareholders, that is amount generated during the period for distributing to unit holders, it actually fell by a ton. It fell from 12.2 million down to 9.3 million. So therefore, the commensurate DPU actually fell from 2.56 to not even 2 cents. It's down to 1.94 cents. That's a humongous, tremendous 24% fall. Okay, so you can see that the latest results then, that came out in August, September, on the first half of this year, sent the share price down by another leg, as you can see in the circle, of the red line, when the share price actually plunged from above or close to 40 cents down to below 30 cents. Now, in our classes, we also have highlighted, and continue to track elite, you see, because some of the interesting things that they have been saying in their presentation materials, we find a little bit hard to decipher unless my English is not too good. Because so what we did is that we consulted the Oxford Dictionary. Take, for example, its latest set of results. They mentioned that elite offers attractive and defensive yield. So, what does Oxford Dictionary says about attractive? Attractive means pleasant to look at, especially in a sexual way. Well, nothing sexual when you look at the share price falling down substantially. So maybe this definition is not appropriate. I think the second explanation on attractive is having features or qualities that make something seem interesting or worth having. So in this case, the fact is that it's attractive, was elite presentation materials trying to say that, because its annualized yield went up to 12.8% compared to, say, the 10-year UK government bond securities of 4.4%. The differential is about 800 basis points, and therefore they look attractive. Or did they did not the attractive view of 12.8% suggest that it's because the price has fallen and the fact that DPU has also fallen, but not as much as the share price? Because the share price, ladies and gentlemen, as the chart shows, collapsed from close to 80, 90 cents down to below 30 cents, right? So therefore, going back to the definition in Oxford Dictionary, so does it mean that they actually have features or qualities that make it seem interesting? Well, if you're holding the stock, definitely it does not fit into the attractive category, right? So the next thing is that you look at defensive yield. So I think the presentation material, they are actually trying to show you that, if for not the fact that if they did 100% payout, their first quarter and the second quarter DPU would be higher as what the blank white box would suggest, and therefore it matches close to the fourth quarter 2022. Okay, now let's delve into the definition of defensive before I show you another table showing something interesting. Okay, that is the meaning of defensive, again, according to Oxford Dictionary, is that protecting somebody or protecting something against attack. Okay, so in this case, if you look at this table, ladies and gentlemen, which is actually that I prepared for our investors in our class, you can see that this is clearly shows that elite is not defensive at all, because if you do a half yearly DPU, that is actually the accumulation based on this particular table is actually from the presentation material, but you present it on a half yearly basis as opposed to quarterly basis. You can see that clearly elite has already shown four, or rather three straight quarters of drop in DPU by from 2.8 cents down to 1.74 cents, or a huge down of almost 40%. So going back to the presentation material that Elite actually presented, let me ask you, how is it attractive? How is it defensive? I know in this video I've got to go to Oxford Dictionary because Strangely, Elite is a first UK REIT, but in fact, I have to go back to Oxford, which is a UK-based institution, to actually look at some of the definition of the terms. Ironical, isn't it, ladies and gentlemen? Anyway, by the way, the meaning of toxic means unpleasant, okay? Delivering unpleasant experiences to you. So at GCP Global, ladies and gentlemen, we always advocate that, when it comes to REITs, it's really very easy. Stay away from toxic REITs. That is, REITs that actually give you unpleasant surprises or treat you in a very unpleasant way, looking at how the share price has performed since they have invested. After all, it's no different from what the late Mr. Charlie Munger, one of my idol, is that to lead a very simple, happy life. He continued to advocate that stay away from toxic people, stay away from things that basically raise your toxic levels, and so that you have more time to concentrate on the key things, right? So what we concentrate on are the good reads, okay? So, but one of the key tenets underlying your search for good reads is to understand how does a bad read, or in this case, how does a toxic read actually shows its colors as it goes through as its listing phase up to now. And again, as I said, Elite, I'm using in today's video. Okay, it is not a criticism of the REIT or the manager, but it is more a learning point of how investors like you and me can actually pick up the warning signs even before the share price hit a bottom. After all, next week, if you're still an Elite shareholder, you notice you have to ask yourself, do I subscribe for the rights? Because are you throwing, therefore, good money after bad? Okay, that's the key question. Okay, so remember, ladies and gentlemen, again, in their latest presentation material, they describe themselves as that they will benefit from a resilient and stable income profile. So once again, I urge you to actually check what's the meaning of resilient and stable in the Oxford Dictionary, not according to the presentation material. Okay, and see whether the REIT has delivered or their portfolio actually give you the resiliency that's actually being expounded. All right. So once again, ladies and gentlemen, in this week's video, we hope we have given you a further understanding to help you to actually pick up, toxic REITs and avoid them. Because really, as humans, as individuals, we are always affected physiologically, psychologically, and mentally if you have certain investments that go bad, like in this case within REITs itself. Okay, so that you have more time to concentrate on finding out and rooting out for the good REITs. Let not your experiences with bad REITs or toxic REITs affect your ability to continue to make good money in real estate investment trusts, because that is what it's all about. Do read my book both in Chinese, published in China, Hong Kong, Macau, as well as in Singapore, Malaysia, the rest of Asia, and soon to be published in the Middle East. Once again, Happy New Year! And once again, this is not an investment advice. This is not investment advice. This is not criticism of the manager or the sponsor, but it serves as a key reference point. It serves as a good example how at GCP Global, after all, it is our 35th year in public teaching, that we have been able to decipher the signs inherent in REITs before they turn bad. So like in Elite's commercial case, we were able to get out many investors at 60 cents, 65 cents and above before the share price plunged to this level. Now, after all, another sign of toxic REITs is this: after the share price has fallen 50%, and if they continue to stay below 30 cents for a long time, you need to ask yourself, is there hope? Now, this is the new year. We present you with hope, okay? But with hope, there must be something that is able to sustain you for the rest of the year, and the ability to analyze and pick out good reads and toxic reads must begin as rule number one for your new year. Once again, Happy New Year, and do join us for our class on 23rd of March, where we go into detail for each of the reads of this reads as what we have done through, for example, with Elite Commercial.